Welcome to This Explainer. You know, it's wild when you think about it. Personal finance forms the absolute backbone of practically all our success stories out there, yet it's completely missing from our standard school curriculum. Today, we're diving straight into the 10 essential financial rules you really need to get ahead of the game. Let's do this.
I mean, seriously, think back to your time in the classroom for a second. What did school actually teach you about money? Did they explain the mechanics of investing? Or maybe how to survive a sudden financial emergency? Not really, right? Traditional schooling tells us to get a good education and get a job, but it completely skips over the actual everyday mechanics of building credit or managing your wealth.
Instead, what did we do? We spent years, literally years, memorizing complex formulas for calculus, studying astronomy, and diving into anthropology. And hey, those are incredibly fascinating subjects, no doubt. But they won't exactly help you negotiate a mortgage rate or figure out why your credit card balance keeps compounding every single month.
Okay, let's dive into this. To master these 10 rules logically, we're going to break things down into 4 key modules: financial foundations, growing your wealth, protecting what you have, and major life expenses.
All right, starting off with Module 1, Financial Foundations. This is all about managing your daily money.
So let's bust a major school myth right out of the gate. We're always told that budgeting means obsessively tracking every single penny you spend. But let's face it, absolutely no one likes doing that. It is incredibly tedious, and it almost always leads to burnout. The real-world rule here is something called tactical budgeting. Basically, this means you identify your needs, wants, and costs, and you plan them out over a 6-month period. Then, you separate those specific funds into different bank accounts. By putting your money into distinct buckets right when you get paid, you naturally prevent overspending, and the best part, you don't have to log every single coffee you buy.
Now, consider this. Recent statistics show that a whopping 40% of Americans do not have the funds to cover a mere $400 emergency. 40%! It's honestly an alarming statistic, and it really highlights just how vulnerable most people are to a sudden disruption. You know, whether that's your car breaking down, an unexpected medical bill, or even a sudden job loss.
So the absolutely crucial point here is establishing the golden rule of the emergency fund. You need to save at least 6 months of living expenses. Notice I said living expenses there, not income. You've got to calculate exactly what it costs to keep your life running, your rent, food, basic utilities, and have half a year of that saved up in a safe, easily accessible place. If you can save more, awesome. But 6 months is your absolute foundational safety net.
Moving right along to Module 2, Growing Your Wealth. Now we're shifting gears from basic survival to active saving and compounding.
When it comes to saving, traditional advice usually throws out the number 10%. They say just save 10% of your income and you'll be fine. But let's be totally honest here. Unless you're pulling in millions of dollars, 10% simply isn't going to be enough to retire comfortably on a regular paycheck. The real-world rule is that you need to be aiming for a savings rate of 25 to 40%. I know, that sounds like a massive jump. But this is where you really have to look closely at reducing daily expenses. Cutting out that daily premium coffee and tossing that cash into a high-interest savings account instead, that is exactly how you start hitting that 25 to 40% target.
Now, what's really interesting here is how this ties into the insane advantage of time and compound interest. Imagine you're given 2 options. Option 1 is a cool $3,000 payout up front. Option 2 is a single penny, but it doubles in value every single day for 30 days. Most people, acting on pure instinct, just grab the $3,000. But let's look at the math on this one. If you choose the doubling penny, at the end of just 30 days, you would have over $10 million. No way, right? But it's true. Setting aside small amounts in high-interest accounts while you're young is incredibly powerful. Your absolute greatest advantage as an investor is time. You don't need to be rich to start out. You just need to let your money compound over and over again for decades. And that brings us to credit. Look, financial institutions need a track record to know you're reliable. Getting a credit card to build that history and always paying your debts on time is the real key here. Completely avoiding credit is actually a huge mistake. There's an anecdote from our sources about a guy named Kevin. He completely avoided getting a credit card for years, thinking he was being responsible. Well, he ended up getting rejected for a loan when he finally needed one, simply because he had a totally non-existent credit history. Don't be like Kevin.
All right, Module 3, Protecting What You Have. We're playing defense now to prevent massive financial losses. Let's rapidly review the essential rules of insurance. First up, if anyone, a kid, a spouse, a parent, depends on you financially, term life insurance is absolutely non-negotiable. If no one depends on you, skip it and save the cash.
Beyond that, you absolutely must insure your major assets, your car, your home, and your health. And here's a great pro tip. Look into umbrella insurance. It covers multiple policies, and you can usually score a really nice bundle discount if you use a single insurer for the whole shebang. And this brilliantly illustrates why understanding taxes is a defensive necessity. Let's say you're offered a $35,000 salary in Manhattan. Sounds okay, but your actual take-home pay is only going to be about $26,399. You have to understand this math before accepting a job offer. Furthermore, say you get a raise from $35,000 to $41,000, you might be thinking, sweet, an extra $500 a month. But because of marginal tax rates, that raise might only yield an extra $345 a month. Oh, and a crucial piece of advice here. Take the time to prepare your own tax returns. It's the best way to fully understand your finances and avoid getting hit with misinformation.
Part of your defense strategy is actually physical. Guarding your health literally saves you thousands in potential medical debt. Just imagine paying out of pocket for a fractured knee. Without insurance, a simple trip to the emergency room can force you to borrow money and totally derail your entire financial plan. But beyond just having medical cover, maintaining a healthy lifestyle, eating right, exercising regularly, prevents a lot of these ruinous bills in the first place. Your physical health and your financial health are deeply, deeply connected.
Let's move to our final section and see how all this builds together. Module 4, Major Life Expenses. We are tackling those intimidating big-ticket items.
So, buying your first home. The common advice we always hear is that you must save a 20% down payment to avoid private mortgage insurance. But here's the real-world truth. In the U.S., real estate appreciation has recently been vastly outpacing our stagnant wage growth. If you can comfortably save that 20% within 5 years, absolutely do it. But if it's going to take you way longer, trying to hit that 20% is kind of like chasing a moving target. Home prices just keep going up faster than you can save. In that scenario, taking on a higher mortgage payment right now might actually be a much better trade-off than waiting years and getting entirely priced out of the market.
Then, there's the biggest ticket item for many, college. Did you know 85% of new graduates complain about the heavy burden of school debt? But massive loans aren't a mandatory part of getting a degree. You can absolutely avoid them with strategic alternatives. You can start out at a community college, work while you study, or seek out more affordable institutions that offer debt-free financial aid. For instance, Davidson College in Charlotte is highlighted in our sources as an incredible example of a school helping students graduate without that heavy anchor of loans dragging them down.
The bottom line on student loans is really just this. Taking on heavy debt should only ever be considered if you are entering a very high-paying career path where the return on your investment is clear and undeniable. Please do not just accept debt as the default condition of being a college student.
Well, traditional schooling might have skipped over these crucial lessons, but now you've got the blueprint. So I'll leave you with this. How will you rewrite your own financial rules moving forward? Will you rethink your budget today, start letting compound interest work its magic, or maybe totally reevaluate your next major purchase? The power to take complete control of your financial future is literally right in your hands.